Hey everyone, it's Zach back with a new mortgage video. Hope you're all having a happy Monday. If this is your first time seeing one of my videos, welcome to my channel. If you're a returning viewer, welcome back, where I'll try to demystify all things mortgage related. If you find this content helpful, please like and subscribe. So I wanted to give a little Monday market preview, all the numbers that have been projected for the key reports, and talk about how that could affect mortgage rates this week. So this is going to be a big week. Last week, there was very little news, and yet mortgage rates went up, which does happen, and especially getting close to the election, sometimes that can lead to negativity, even when there's no real news to explain the movement. But this week, after today and tomorrow, there's going to be significant reports every day. The most important ones are going to be the jobs-related reports. We have PCE, personal consumption expenditures, coming on Thursday. That is typically an important inflation report. It's the Fed's preferred metric for inflation. However, I think in this case, with where we are in inflation, where it has come down quite a bit, the jobs data is really going to be the biggest market mover. And if you look at when mortgage rates started to really creep up in the past 90 days, it really started with, it's gone a couple different ways because of the reports coming this week. First in August, we had, or early September for August, we had this extreme improvement in mortgage rates because we had an uptick in unemployment. Then this past month, we had the opposite, where unemployment came in lower than expected. Job openings, the non-farm payroll report, came in dramatically higher than expected, and that hurt mortgage rates. Start with ADP employment. This is a report that comes out Wednesday, and it shows job creations. It's kind of paired with non-farm payrolls, which will be Friday, which identifies kind of the same thing, but just slightly different methodology. So last month, that report came in at 142,000 openings. This month, projection is 113. So the expectation is that there are going to be fewer openings when it comes to the ADP report, and also for non-farm payrolls. Last month, like I said, it came in dramatically higher than expected at 254,000. We were expected to get like 150, something like that. Right now, the projection is 110,000. So less than half of what it was last month, which I feel like is not a great projection. I find it hard to believe that we won't come in higher than that to some degree. But if it's only, like 10 or 20,000, I doubt that's going to make a real stir. The biggest number that I want to talk about is unemployment rate, because unemployment rate, these other reports, it's really hard to project them based on other data. There's not really any leading indicators that say, based on XYZ, this means we're going to get this many job creations. That's not the case with unemployment. You have initial jobless claims, which is released weekly, and that paints a very clear picture of what's going to happen with unemployment rate. So far this month, we started out with really high initial jobless claims, and while it has ticked down, we're still currently in the range where we were back a couple months ago when we had a 4.3 unemployment rate. As of right now, the market's projecting a 4.1% unemployment rate on Friday. There's still one more initial jobs claims that comes on Thursday. So if that comes in dramatically lower than any of the other ones, then that might change things. But as of right now, I find it hard to believe that unemployment's not going to tick up at least a little bit. And I think if it only goes up to 4.2, especially if these job openings, which again, both numbers I'd say are pretty low for both ADP and non-farm payrolls, if those come in higher than expected, which I would say is more likely than not, I think maybe we get worse mortgage rates, if not, very little movement. I think the key is going to be if unemployment goes up higher than 4.2, like back to 4.3, certainly to 4.4, which is where the Fed expects unemployment to be at the very end of the year. meaning we're already where they're, and you figure they're expecting it to trickle up slightly. So if we have a big jump, suddenly that changes things. Maybe the Fed is going to want to make a 50-point rate cut rather than the expected 25 points is baked into next week's decision on November 7th. And more importantly, even if we only get a 25-point cut, if we see a real uptick in unemployment after that meeting, I could see Jerome Powell making comments to suggest, hey, maybe we need to cut more rapidly if we continue to see unemployment go up. And that would be very good for mortgage rates. So as always, if you have any questions or comments, either shoot them below or call, text, or email me anytime. But thanks for tuning into this video, and I'll see you next time.